Welcome! If you're watching this right now, you're about to step into one of the most exciting, high-stakes chapters in the crypto world. Because right now, with Bitcoin, Ethereum, altcoins, institutional flows, derivatives, and regulation all colliding, we're standing at a crossroads, and whether you ride this wave or watch it pass you by may depend on what you do in the next few weeks. Today, we dig deep into the seismic shift. The launch of perpetual futures trading for Bitcoin and Ether, the institutional adoption surge, the regulatory tremors, and the altcoin breakout storm. We'll map how this could trigger the next major bull run, or the next big crash. We'll explore why smart money is moving now, where the biggest opportunities may hide, and how you can position yourself with the right crypto mindset. So buckle up. This is not your usual top 5 coins list. This is about strategy, timing, risk-reward, and we're going all in. Let's begin by setting the scene. The flagship asset, Bitcoin, BTC, has broken through resistance levels. Institutional interest is surging, and we're seeing something rare. New derivative products aimed squarely at crypto. For example, the Singapore exchange, SGX, is launching perpetual futures for Bitcoin and Ether, set to open 24/7 trading to accredited and institutional investors. That matters hugely, because when derivatives deepen, when futures, options, perpetuals, and leverage arrive, the market doesn't just move, it can accelerate or reverse in a blink. Now imagine you're in an asset that just got a faster, more intense channel for flow, speculation, and hedging. The risks go up, the reward potential goes up, and the margin for error tightens. Why is this derivative expansion happening right now? Because institutions are telling the story. They want exposure to crypto. They want hedging tools. They want to scale fast. Meanwhile, retail is watching, FOMO is brewing, and the headlines are flashing next leg up. But the environment isn't simple. We still have macro risks. Regulatory concerns, liquidity questions, market sentiment is cautious, even as many analysts point to key altcoins and layer 1 projects as ready to explode. That means, as a trader or investor, you need to think in terms of timing and mindset, not just buy and forget. Here's what most people miss. When derivatives explode, liquidity flows change direction, short squeezes become real, and the cost of capital shifts. What happens when institutional perpetuals open up? Suddenly there's 24/7 access, more leverage, more trading volume, but also more volatility. That means Bitcoin could see sharper spikes and deeper corrections. As the headline said, Singapore exchange to launch Bitcoin and Ether perpetual futures. That's a major gate opening. Now imagine that, globally, similar windows open. Then market structure changes. Then altcoins, which often follow Bitcoin's lead, can light up. So what should you be watching? First, open interest in futures. How many contracts are being created? Is it mostly longs, shorts, or a mix? Because that tells you where the pressure is. When open interest shoots up, and most of it is long positions, the risk of a blow-off top increases. Second, funding rates. When funding for longs becomes expensive, it signals exuberance and often warns of a topping third, option skew. When the cost of hedging large moves is high, markets may be pricing in risk. And fourth, altcoin volume. When alts begin catching up to Bitcoin in percentage gains, that's often the early sign of a full spectrum move. Now, for Bitcoin itself, we are likely in the early stage of the next major leg. Many models and analysts are pointing to 150,000 to 200,000 plus as plausible targets in this cycle. But danger. If derivatives leverage ramps too soon, we could see a cascade event where forced liquidations trigger a sharp 20 to 30% drop in hours. So the mindset isn't just hold. The mindset is prepare, adapt, hedge. And that is the heart of the Crypto Mindset channel. Let's zoom into altcoins, because while Bitcoin may lead, altcoins often explode once momentum is confirmed. Recently, analysts listed the top 10 cryptos to invest in as of November 2025, including Bitcoin, BTC, Ethereum, ETH, XRP, Binance Coin, BNB, Solana, SOL, Tron, TRX, Dogecoin, DOGE, and Cardano, ADA. These names are being talked about, but the hidden opportunities lie in smaller cap projects that benefit from derivative leverage, institutional flows, token unlocks, ecosystem catalysts. But with higher reward comes higher risk. You must evaluate fundamentals, tokenomics, utility, and smart money signals. Here's a crucial pivot: regulation. The regulatory environment is shifting fast. For example, stablecoins are being legislated. The Genius Act in the US is shaping how stablecoins must be structured and backed. That means stablecoins, often the plumbing of crypto flows, are under new rules. When flows change, timing matters. When stablecoin supply, redemptions, and regulation change, the entire market's risk-on-off dial can flip. If stablecoin redemptions accelerate, altcoins may crash. If regulation eases flows, crypto could rocket. Think of this as a three-phase model. Phase 1. Institutional derivatives open up. More capital flows. Volatility rises. Phase 2. Altcoins catch up. Momentum broadens. Breakout phase. Phase 3. Regulatory or macro shock. Either bull-full thrust or crash. Your job is to monitor where we are between phases. Right now, we believe we're transitioning from Phase 1 to Phase 2. That means the next 2 to 4 weeks are critical. If altcoin volume doesn't pick up, and if futures open interest stagnates, we risk a pause or correction. On the flip side, if volume explodes and derivatives continue to ramp, we could see a sharp leg higher. Let's map real scenarios. Scenario A. Bitcoin rockets to $150,000 in next 90 days. Altcoins 3 to 5 times gains as momentum spreads. This happens if institutional flows ramp, derivatives squeeze, regulation stays supportive, stablecoin supply expands. Scenario B. Bitcoin stalls or dips 20 to 30% amid macro/regulation shock. Altcoins collapse, derivatives unwind. This happens if margin calls hit, funding rates go extreme, regulators intervene. So what do? You hedge, you scale, you set stop losses. You watch not just price, but flow metrics. You remain agile. Now let's talk strategy. First, size your position relative to risk. Do not bet the farm. With derivatives, a 5 times move one way or the other is totally possible. Second, use stop loss or hedges, perhaps short a small portion, or use option protection. Third, enter altcoins when Bitcoin shows strength and volume picks up in alts. Don't chase the first breakout, wait for confirmation. Fourth, be aware of token unlocks and vesting schedules. They often lead to mid-cycle corrections. Fifth, keep an eye on regulatory headlines. They move markets faster than you think. Important keywords you should track in your crypto dashboard: perpetual futures, open interest, funding rate, whale accumulation, altcoin season, Bitcoin dominance, derivative squeeze, stablecoin flow, institutional adoption, crypto regulation. When you see multiple of these lighting up simultaneously, alert mode on. Let's go deeper into example opportunities. Suppose you spot an altcoin with low market cap, strong fundamentals, and suddenly a spike in volume while Bitcoin is stable or rising. That may be early signs of altcoin season. Combine that with high open interest in Bitcoin. For example, if Bitcoin derivatives are dominated by longs, altcoins may outperform. But the risk? If Bitcoin funding rates blow out, we could get a sharp unwind. So one practical move: allocate a small core to top coins, BTC, ETH, a medium weight to promising alts with strong fundamentals, but keep some dry powder ready for dips. Use stop loss on high-risk alts. Another important nuance: When Bitcoin dominates headlines, alts often lag and then catch up explosively. So if you're early in the cycle, which I believe we are, you want exposure to alts, but you want those alts to have real use case, governance, tokenomics, and ecosystem momentum. Don't just buy because of hype, but buy early when the hype signal is still weak and risk-reward is favorable. Now let's talk risk again. With increased derivatives, liquidity becomes fragile. A large whale liquidation could trigger cascading liquidations. When open interest is high, liquidation risk is high. Also, regulatory risk. A single tweet or announcement from regulators can cause 10 to 15% crypto moves within hours, so your mindset must incorporate risk control. Use smaller positions, have an exit strategy, know your time horizon. What about DeFi and stablecoins? Recently, research points to stablecoins being foundational in the next wave of blockchain adoption, and regulation is tightening. That means places where stablecoin flows go, exchanges, DeFi pools, lending markets, those will look like pressure valves. One day, stablecoin flows may accelerate altcoin moves. Another day, regulation squeezes stablecoin supply and causes reversals. Stay alert. What about the narrative? Crypto is shifting from Wild West retail speculation to institutional infrastructure, derivatives, regulatory frameworks. The tone is becoming professional. The question, will this institutional influx bring long-term stability and massive growth, or will it bring large-scale systemic risk and a new kind of crash? No one knows for sure, but you can prepare. Your mindset, your strategy will make the difference. So let's walk through a practical checklist you can use after this video. Check Bitcoin open interest and funding rates. If funding 0.05% daily and open interest rising fast, we're in acceleration. Check altcoin volume ratio to Bitcoin. If altcoin's volume begins to rise relative to Bitcoin, you may be entering altcoin season. Check stablecoin supply and flow into exchanges. Growing stablecoin inflows equals more fuel for moves. Monitor regulation headlines, especially for stablecoins, derivatives, exchange licenses. Set defined risk budget. Know your stop loss. Know your time horizon. Be patient. It's okay to wait. The opportunity isn't gone if you're not first. It's gone when you miss the trend or ignore the risk. Okay, let's project. If Bitcoin hits $150,000 within 90 days, you'll want to be invested when that breakout is occurring, not chasing after the 10% move has already happened. If altcoins begin rallying, rotate into quality alts, but don't abandon your core. If you see signs of unwind, funding skyrockets, margin calls piled, stablecoin flows retreating, regulatory crackdown, you may want to take profits, hedge, or even reduce exposure. And maybe most importantly, mindset. The crypto mindset isn't simply bullish or bearish. It is adaptive, opportunistic, and risk-aware. It's the ability to pivot when the trend changes, to scale in when the evidence builds, to scale out when the heat looks too high. It's applying institutional-grade thinking even as you trade retail-style flexibility. As we wrap up, remember, we are at an inflection point. With the launch of derivatives, institutional access, altcoin breakout potential, and regulatory change all aligned, the next move could be large, but large moves don't always go up. The same structure that allows a 3x move also allows a 50% drawdown if things break. So you must stay alert, stay educated, stay agile. If you can do that, if you can combine timing, strategy, risk control, and horizon, you will be positioned to benefit, not only survive. That's what crypto mindset is about, not hype, not blind faith. Strategic thinking in a fast-moving market. Thank you for watching. If you found value in this deep dive, hit like, subscribe to the channel, ring that notification bell so you don't miss tomorrow's update where we'll track the unfolding derivatives flow and highlight the top 3 altcoin setups I'm analyzing right now. Until then, stay sharp, stay informed, and keep that crypto mindset. See you in the next video.